So is the idea with these debt-driven cycles, we were prone to these kind of blow-up type situations where things eventually blew up. Is it the idea we're less likely to have that in an income-driven cycle than we were in a debt-driven cycle?
Yeah, that's exactly right. I mean, and this isn't by chance. Like what happened was we had the GFC, and basically everyone in the regulatory framework was like, no more GFC type dynamics, right? We're going to totally restructure. The banks have been restructured to have lots more capital. It's hard to remember, but in 2006, 50% of U.S. mortgages were floaters. Today it's essentially zero, right? That's a huge restructuring of the way in which debts are serviced in the economy. 15, 20 years ago, lots of companies borrowed through CNI or, other loan arrangements. They were borrowing on floaters. Today, big companies basically term out long-term fixed debt, at low yields. And so we went through this whole process of households, businesses, financial intermediaries. We want to make sure that they can withstand a rise in interest rates, so we don't have another crisis type dynamic that we saw in 2008, which was, a terrible outcome for, millions of Americans. And we have been very, very effective at doing that. But the consequence of that means that the Fed's power to slow the economy is much weaker today than it was back then. And the likelihood that we get a cascading, self-reinforcing negative dynamic is a lot lower today than it was back then. And so, it's not a random outcome. We sort of purposefully said, let's restructure our economy to have it look a lot more like the 50s and the 60s than to look like, the pre-GFC type economy.
And just one question on that. Is there any risk that the debt has moved from the public over to the government side? And thinking where there might be like levels of debt that could be problematic. I don't know what what you think about that with the level of sort of debt in this country. I mean, businesses are in good shape, consumers are in pretty good shape, but what about the U.S. government?
Well, the U.S. government's got a lot of debt, and I think the U.S. government's indebtedness is, and government's indebtedness is a little different in terms of how to think about it than private sector. And the primary reason why that is that the central bank has the ability to essentially write off existing debt stock if the level of debt is too high, or if the price that is required by the market to finance it is too high. And so I don't think that like the current level of debt, or even a higher level of debt, is not that interesting. Like, go look at Japan. Japan has tons of debt, right? And what did they do? They just printed money and basically retired the debt, right? And they have the lowest interest rates in the developed world. So it's not like just because you have high debt, you have an interest rate problem, right? The question is basically, what is the appropriate level of interest rates for an economy given its macroeconomic conditions, and what needs to happen for the central bank to respond to basically ease the debt burden that might exist. And so in the U.S. case, if you look at the overall picture, if anything, it's probably that the current interest rate level is too low, not too high, right? And so maybe the debt burdens, are we going to probably pay off all the debt, dollar for dollar the way it's currently issued? Like, probably not. Okay, that's a 20 or 30 year time frame story. Like, as a someone who thinks about it in sort of a 3 to 6 month time frame, like, who cares? Like, yep, the U.S. debt will not be paid back dollar for dollar, or you're probably not going to get the same, real return that you might expect as a function that you've historically gotten. Okay, so what? What does that mean today? No, if anything, yields need to rise, not fall today, given the strength of the economy. And so the path, and this is, I think people like skip a few steps here. Like, what needs to happen in order for the debt burdens to be unacceptable is first yields have to rise, and yields and the yield curve have to be too steep relative to the underlying fundamental conditions. And then the central bank will come in and will ease through the purchase of securities if necessary, right? First, the central bank will lower the short-term interest rate. And then if the long-term interest rate doesn't play along the way it needs to, then they'll buy the long-term bonds in order to bring the interest rate down. But we're at the beginning of that path, not at the end of that path. So the way I describe it is there has to be a lot more pain in the bond market before we get the types of interventions that would align with the fact that would align with the central bank basically buying out the existing debt stock and reducing the debt burden.